There we go. E ngā iwi, e ngā mana, e ngā hoa mahi, tēnā koutou katoa, ko Dominick Stevens tōku ingoa, nau mai haere mai ki te tae ohanga. I'm Dominick Stevens, Chief Economic Advisor at the Treasury, and welcome to our post-budget Economic and Fiscal update. We've got a relatively intimate sort of 20, 25 people in the room, so thanks to those who've made it in person, and I think we've got a large number of people online, sort of more than a couple of hundred, so I expect this is, I know that a lot of the people who tune into this are civil servants, and I expect this is people sort of adhering to the exhortation to work from the office and watching this from their desks. But yeah, the plan today is to go through how we were seeing the economy and how the budget has evolved and how one is going to influence, or how those two things are going to influence one another. Let's just start with a little bit of health and safety for those in the room. In the event of a fire alarm, please follow Treasury staff to the nearest exit and progress down the stairwell. Do not use the lifts. In the event of an earthquake, drop cover and hold, stay in the building, and bathrooms are down the hall through the door and to the left. I'll be speaking for sort of 45 minutes or so, then we'll have time for question and answer. That'll be intermediated by, we'll do a hybrid of in-person and online, so we'll have somebody to intermediate the online questions, but we can also take them from in the room. And I have a number of sort of Treasury people here to help me answer questions on topics that are of a multitude of details, as I'm sure they will be. Okay, so let's get into it. I'm not getting a response. So what do I do to make it go forward? Cool. Okay, thank you very much. Okay, so I guess the bottom line for the presentation is the economy is turning the corner. So we've experienced a really deep downturn. We think we're seeing evidence. We've been saying for some time that it's going to turn the corner and we're going to enter a recovery. It is doing so, albeit a little more slowly and a little bit more hesitantly than previously expected. It's an export-led recovery at the moment, reflecting a real two-speed economy. So rural regions doing a lot better than the cities. But the thing about an export-led recovery in a world where tariffs have suddenly emerged, you've sort of got some risks on the horizon, and we'll certainly talk about that. That slight downgrade to the economic growth forecast has meant it's negative for revenue going forward. Government actions have slightly offset that, but not fully, and therefore we get slightly larger deficits in this budget than we had at the half-year update. One thing I want to talk a bit about is some of the big picture challenges that New Zealand is facing. We've got a structural deficit, we've got population ageing, and we've got productivity challenges. And I'll talk a little bit about how the initiatives in this budget go towards addressing that. And one little hint I want to make just before we start. So what you see in the chart there is our forecast of GDP growth versus the picture that I put up at the half-year update. And you'll see actually in history, we've had this really big revision to GDP. So just as we go through, that's going to affect all sorts of things. It'll affect our impression of productivity over the past. It'll affect the debt to GDP ratio and where we're at with that. It will affect all sorts of things on the way through this story. So I just want you to sort of bear that in mind as we go through. As I say, the story so far to date has been, we had COVID. We had a very large fiscal and monetary policy response to deal with an expected large recession resulting from COVID. Actually, the economy rebounded more rapidly than expected, and both in New Zealand and overseas, lockdowns constrained supply. So we had plenty of demand, limited supply, and that led to inflation both in New Zealand and overseas. And in New Zealand and overseas, interest rates were required to rise in response to offset this inflation. In doing so, they tend to slow the economy, so we did experience a recession. The economy has duly slowed to a pace and a level of activity that's a bit more sustainable. Inflation has followed and come down, and interest rates are now falling. And this is the key reason that we do expect the economy to sort of turn around from here. Those high interest rates were really constraining activity, and now that is being unwound. Inflation, I mean, we expect it'll sit over time really close to the centre of the Reserve Bank's 2% midpoint of their target range. There is a near-term blip coming, and that's to do with the exchange rate having dropped away and what that's doing to import prices. But we expect that'll be fairly short-lived. So yeah, as I say, we had a severe recession. It was actually more severe on a per capita basis than overall. So 4.8% decline in per capita GDP from peak to trough, which was larger than the global financial crisis. At times, the recession was sort of masked by really strong net migration, which was providing its own little boost to activity. But then during 2024, we had moderate net migration and ongoing declines in per capita GDP, leading to a 2.2% decline in GDP through the middle of 2024. Q4 2024 experienced 0.7% growth. Treasury is forecasting 0.4% for the first quarter of 2025, and 0.7s and 0.8s thereafter. So a moderate turnaround, as you can see. The unemployment tends to lag the rest of the economy. So we don't think it's peaked yet. We think it's got a little further to go. We'll peak at 5.1 at the moment. We think it'll peak at 5.4. But we are expecting once the economy returns to growth that the unemployment rate will start to moderate down towards long run level of about 4.25%. So what gives us such certainty that we've sort of turned the corner and the recovery has begun? Well, there's a really wide range of evidence, which some of which I'll show you at the moment. One of the most up-to-date indicators of business activity is the BNZ Business New Zealand Performance of Manufacturing Index and Performance of Service Index. And I remember at previous iterations of these events, I was talking about how these are below the 50 line, indicating that businesses are telling us that activity for them is contracting. This is a monthly survey. The manufacturing index has returned to growth and the service index is around about neutral. So there has been a return there. There are really good surveys out there that ask firms what's happening. The ones that ask what do you expect to happen have improved quite a bit over the past 6 months or so. So firms believe that we've turned the corner, and they've believed that for a little while. But the one we pay most attention to is actually when you ask firms what's happened in the past 3 months, because that's sort of closer to something you can really hang your hat on. And that has slowly started lifting and is consistent with GDP growth sort of gradually starting to emerge. Consumer confidence likewise has lifted. Peter and his team did business visits all around the country. We go out and talk to businesses. They weren't sort of screaming about great times, but they were indicating that they felt things were turning the corner, and they certainly felt a bit more optimistic going forward, although they didn't really demonstrate much keenness to invest or employ just yet. So it really did feel like sort of early stages when we did that process. I mean, one thing about what we've had in recent years, if you think about it, during my career, I've often encountered skepticism about monetary policy and whether it works. And I think in recent years, we absolutely, it's been an abject lesson in yes, it does. We dropped interest rates, activity took off, inflation took off, interest rates had to rise, it had the opposite effect. Now interest rates are falling and you can see the effect coming through. So I think this is, this has been a tumultuous time for New Zealand. We've been through all sorts of ups and downs. But one lesson that we've learned and that I think we need to adhere to is, well, monetary policy really works. One of the ways that it works is through the housing market. So what we are seeing now as interest rates start to fall is house sales, having gone through a real dearth of sales, house sales are starting to pick up, and that is a fairly good indication that house prices will soon start to pick up. Actually, they've been rising very slowly for 6 months in a row now, through to April. They were previously falling, so the annual change is about 0, and quite variable across the country, -4 in Wellington to, I think it's about +4 in Canterbury. But yeah, the housing market is turning the corner. Treasury is expecting a return to modest rates of house price growth from here. So 5.6% is our forecast for the coming year, and just over 5% per annum thereafter. Just the one thing about the way that interest rates affect the housing market, I think a lot of people were perhaps expecting something even greater as interest rates started falling. A couple of things to remember: long-term mortgage rates, so the longer-term rates have fallen only a little, and I think it's really the big picture changes in interest rates that matter for the housing market. So I think what we're experiencing at the moment is a largely anticipated decline in mortgage rates that's having only a modest effect on the housing market. Secondly, our models and what have you actually would have told us that had interest rates stayed where they were a year ago, there would have been a lot more downside in the housing market. So if anything, what's happened is we've avoided downside. The housing market is one thing that often influences consumer spending. Free cash flow is another, and that's influenced by how much outgoings people have on their mortgage. What we're seeing in retail card spending is arguably a turn, arguably a slight improvement, but not much. And if you think about it, with prices still rising, population still growing, it is still a pretty soft picture for consumer spending, at least on a per person basis. It's perhaps not quite as soft as it was, but it's turning slowly. And to be fair, this side of things is probably turning a little more slowly than we anticipated at the half year update. Migration has been, as I mentioned earlier, it's been a really big part of the ups and downs in the economy in recent times, and this too appears to be settling down. So we had a real dearth of migration, gross migration inward and outward during COVID. Obviously, the borders were closed or near closed. Post-COVID, we had a huge influx of non-New Zealanders on net into New Zealand. There's a few things going on there. One, there were an overhang of people who had the right to migrate to New Zealand but couldn't exercise that right during COVID arrived. Secondly, we were really short of labour. So there was a desperate desire to bring people in. It is easier to bring people in if they have a job offered to them already. So you're more likely to get a work visa in that situation. What we found during this big surge, we normally get a mix of people from around the world, but this big surge was disproportionately Asian, so Philippines, India, China. We normally get a mix of skill levels, but the big surge was disproportionately lower skill. And work visas are normally the biggest category, but that was the category that really surged temporarily during that time. So it was lower skilled workers coming in to meet a need. As the need waned because the economy slowed, people coming in on a temporary work visa are required to leave. There are fewer people who are able to get a work visa because there's not as much of a desperate need for workers, and you tend to see the non-New Zealand line dropping away. Meanwhile, New Zealanders leaving. So again, the same phenomenon. We've got an overhang of people who wanted to leave during COVID but couldn't or didn't want, needed to delay that, and are now exercising their desire to go on the OE. Secondly, New Zealanders tend to emigrate more when the economy is slow, and it is right now. Interestingly, that's a really good indication of trans-Tasman migration, but what's happening in this outflux is a disproportionate number of people going beyond Australia. I don't know what the explanation for that is, but it's an interesting phenomenon. And secondly, the people leaving are a little bit older than they have been in previous outfluxes. So the 30 to 39 category is the one that's grown disproportionately. All age groups have grown in terms of how they're leaving, but it's the 30 to 39 that's grown the most. I would expect that in time, as the economy normalises, you'll see that blue line lifting a bit, and indeed we're forecasting net migration to lift back to a long-term average of 40,000. But yeah, I think that story is roughly sort of settled down, and there hasn't been a huge change of surprise relative to our previous forecasts. As I mentioned before, the business investment side and the construction side, so that's the part of the economy that is a little bit slower. Businesses aren't yet quite really investing. We expect that they will, and I'm going to talk a lot more about business investment when I talk about tariffs and when I talk about the budget and the investment boost policy. The construction sector, so residential construction, dropped away 22% from peak to trough. And you've got to remember it was a really big peak. Anybody who tried to get the house renovated around COVID time like I did sort of paid the price quite literally. So it was a big peak, 22% drop. That compares to the global financial crisis when there was a 31% drop. So it's becoming comparable. There are early signs that this is turning. So the green line is the number of building consents that has turned, and that's a pretty reliable indicator that you're going to see something of a turn in the amount of construction that actually gets done. It's normally 6 to 9 months later. And then if we're right that house prices start slowly rising, you'd expect to see the frequency with which people renovate or build new houses just lifting that little bit over time. The other aspect of the economy that should be considered slow is government consumption. So government consumption, that's the money that government spends on our behalf on the likes of the police, teachers, defence force, that sort of thing. It was actually a really big part of growth in the economy from sort of 2014 through to the early 2020s. And that has really changed. So the rate of growth in government consumption has flattened. There are those past revisions to GDP, but if you look at the slope of the line, we're expecting slightly less growth going forward than we were at the half-year update because the government's been a little bit more constrained than we had previously forecast. So going forward, government consumption is anticipated to decline quite rapidly as a proportion of GDP. So later on, I'll talk about the allowances that the government has set for future spending of $2.4 billion for each budget. Treasury practice is to assume that those allowances go into government consumption. That's just a forecasting convention. But even if that's the rate of growth in government consumption and the allowances and it's spent on government consumption, it is not enough to keep up with cost growth and population growth. So relative to the size of the economy, you'll see government spending dropping away if those allowances are adhered to or undershot, and dropping away quite rapidly. And I think the interesting thing will be to see whether that comes about, how much of that can come about through efficiency measures and how much has to come about through other measures. I just do want to emphasise that is a forecasting convention that Treasury adopts. So in reality, the government does face choices about how it exercises those $2.4 billion allowances. So the main point is government's not going to be such a big source of growth for the economy. So the growth needs to come from the private sector, or the growth that we're anticipating will come from the private sector. So far I've talked about, sort of consumption turning slowly, migration not really doing much, government not a source of growth, and business investment is going to turn but hasn't yet. So I haven't really given the guts of, okay, what it is that is really turning. And I think the thing is we are unambiguously in a good old-fashioned export-led recovery. What we're seeing is a real two-speed economy. So as you travel around the country, you'll find that smaller regions that are really backed by rural industries are doing a lot better than the cities at the moment, and it's really quite palpable. The commodity prices, so the price of the things that we sell to the rest of the world, dairy, meat, and the like, are sky high, reaching record highs. Dairy payout, in combination with world prices being very high, we've also got a drop away in the exchange rate. And that's led to a dairy payout this season of $9.70 to $10.30 is Fonterra's guidance, and $10 is the early guidance for next season. So those are really very high dairy payouts. It's not just dairy, as I say, meat is also doing well. There are supply issues overseas that have led to high world prices for beef and lamb. And these really key industries for New Zealand are generating quite a bit of income at the moment. So the terms of trade, which measures sort of our standing globally, the value of what we're able to import in exchange for what we export, is close to the all-time highs that we were experiencing at the back end of last decade. So it's we're really starting to see the effect in the rural economy and in regional economies, and this is where the turnaround is really been led. And this has definitely exceeded Treasury's previous expectation, making up for the way the consumer spending slightly undershot our expectation. Okay, so export-led recovery in a two-speed economy, that's great, but what happens when tariffs come along? Because the very thing that is, trade is the very thing that is leading the way in this recovery. So tariffs do present a real risk to the forecast. Look, I think being a forecaster in this environment is just really, really hard on a daily basis, or feels like on a daily basis. Really major changes in the rules are put in front of us, and we're sort of trying to keep up with it. Treasury actually finalised its forecast, I think it was April the 6th or 7th, which is a matter of 3 or 4 days after the Liberation Day tariff announcement that so shocked the world. Of course, we knew something was coming, and we had to react quite quickly to the April the 3rd announcements. And what we decided to do is just make placeholder assumptions at this point, because while we knew what the numbers were on that day, as we've subsequently found, the actual tariffs that get applied around the world could be, they've changed a lot, and they could continue to change. So exactly what the rules are around change is highly subject to uncertainty. Secondly, for any given set of tariffs, the effect on New Zealand is also wildly uncertain. It's really quite hard to anticipate. There's excellent modelling going on and lots of modelling work happening at Ministry of Foreign Affairs and Trade, Treasury, Reserve Bank. We're doing our best, but the fact is the impact, we haven't seen something like this in a relevant time frame, and the impact is really quite hard to anticipate. It's quite possible that, probably the main thing is if global growth slows, that'll affect our exporters. Obviously, if our exporters face tariffs to the United States, well, that's going to affect us, although the US is only 13% of our trade. But if competing countries face bigger tariffs, that could well be a benefit to us. And if countries that produce goods once destined for the United States decide that it's no longer economic to sell them there, they may well sell them more cheaply to us, which would be a benefit to our economy. And it's really quite hard to anticipate which of those effects will dominate over which time frame. And therefore, we just made a solid set of assumptions this time. The plan is sort of lay them out really clearly. This is what the assumed impact, and we will reassess as time goes on. At the half-year update, we'll reassess those assumptions going forward. So we lowered our forecast of global growth by 0.4% in the year to June 26 and 0.3% in the year to June 27. So we're anticipating a sub 2% global growth, which doesn't sound, for global growth, that is actually quite a slowdown. And we anticipate a lift in global inflation. You're going to see more inflation in the US and less in China. But the US inflation, we think it will be on net inflationary because the global trading system will be less efficient. So there'll be less efficient means of production, higher prices. After we made these assumptions, the likes of the IMF came out with their own placeholder assumptions, and they're very, very similar. So we're sort of in line with the way others are managing this. Secondly, financial markets are already reacting to the likely tariffs going forward. And on a daily basis, they're reacting to as best they can to the news. So at the time we finalised, the TWI had dropped sharply. So the New Zealand dollar exchange rate had dropped sharply to 67.8. We assumed it would slowly recover. In fact, it's actually recovered quite a bit more than that post finalisation. Oil prices had dropped away. They have recovered a little bit. And bond rates, so interest rates on government debt around the world, including in New Zealand, rose after the tariff announcements, and they're at similar levels now. But just on those bond rates, I think that's a really important topic. They first rose late last year, early this year, in both the United States and in New Zealand. There's been a little bit of up and down, but with the tariff announcement, there was a further round of bond rate increase. The big thing that's happening is just sheer volume. So governments are borrowing a lot. They're tending to find economies are falling short of expectation, just as in New Zealand. Governments are borrowing a lot, and central banks are selling back the big stocks of government debt that they built up to fight the threat of deflation last decade. So quantitative tightening is occurring. It's just this huge volume that the market's having trouble swallowing. But secondly, I mean, there's a bit of worry out there that adherence to fiscal discipline in big countries in the United States is perhaps not what markets would like, and they're getting a little bit worried about their funds. I noticed one of the three ratings agencies recently downgraded the US from the top notch. The same concerns are happening in the UK. So around the world, governments are not really demonstrating a huge ability to rectify deficits and get debt under control, and markets are starting to go, okay, well, perhaps I want a higher interest rate for government debt relative to other forms of debt than I previously asked for. And New Zealand is caught up in the same phenomena. So we're also issuing more and more debt, but we're competing with other countries that are issuing more debt, and it's driving our interest rate higher. That's got implications for debt servicing in our budget, but it could have implications for corporates in New Zealand that find, well, if they want to borrow, they need to essentially outbid the government, which is a safer bet. So it could well affect corporate interest rates going forward in New Zealand and have a very real effect on our economy. So just getting back to the tariffs. So we assumed lower global growth. That has an effect on our export prices. So we have assumed that our export prices come off. Secondly, there's been all this back and forth on the tariffs, and I think it is just a very uncertain time for businesses. And we have assumed that has a chilling effect on business investment. So we pulled 0.6% per annum for the next 2 years out of our business investment growth forecast, in recognition of the chilling effect that the uncertainty may well have. And look, I'm the first to admit that there are wide bounds of uncertainty around that, but as a central forecast, that was a reasonable assumption. And then secondly, I would actually view what's happening globally at the moment as a continuation of a trend that's been in place for a decade at least, and that is globalization. So we had the world globalized from the early 1990s to the mid-2010s. Trade as a proportion of economic activity shot up. Whole regions of the world essentially joined the global trading system. New ways were found to produce goods and services. Value chains were established where a little bit of value was added to goods, and whole countries specialized in, or regions specialized in aspects of that value chain. And it really drove the price of stuff that we import down steadily over time. New Zealand hasn't had great productivity growth itself, but it has participated in the global improvement in productivity through this. Other people have improved their means of production, and we have benefited through cheaper imports over time. Observing the globalization trend, the retreat from globalization that I would say started, in my mind, it started with Brexit, really. That was the first time the penny dropped for me that, oh gosh, people are starting to move away from free trade, and was perhaps amplified in the first Trump administration. And these tariffs, to me, are just another event on what has been another signpost on a path that we've been walking for some time. And so for a long time, Treasuries has assumed that this downward trend in our import prices would level out. And that remains the assumption in these forecasts. And secondly, one thing I'll talk about soon is productivity growth. So we've observed that it's slowed. I think one of the reasons is the retreat from globalization. And again, we have assumed that productivity growth will be a bit slower going forward, partly for these reasons. Again, first admit that there's just wild uncertainty. So those are the assumptions we've made, and we will update them at the half-year update and update the fiscal consequences. But to help, We've painted some scenarios. Downside scenario indicates a sort of a worse export and global picture for due to tariffs. Upside scenario is more of a rebound in productivity and a burst of extra migration. I think the key point is, in that downside scenario, nominal GDP is $40 billion lower over time than in the central scenario. And that equates to $12.3 billion less revenue averaged over 4 years, or $4 billion per annum at the end of the forecast period. Which is, if you think from the government's perspective, $2.4 billion allowances, if that scenario emerged, it really is quite a different fiscal picture. And vice versa for the upside scenario. Okay, so that's an update on how the economy is progressing at the moment and how we're thinking through and modelling the tariffs. Before I get to the fiscal picture, I just do want to run through a few pieces of context, bigger picture context that we're facing into as we develop this budget and as the government developed its strategy. The first is, I've already mentioned, it's slowing productivity growth. So productivity growth averaged 1.4% per annum from 1993 to 2003. By productivity, what I mean is the amount of GDP generated per hour worked. So it grew 1.4% per annum for decades. It slowed to essentially zero from 2014 to the end of 2019. During COVID, it took off again, and we thought, well, part of that's probably just temporary, but it seemed like the decades-long trend was re-emerging, so our forecast was for some unwind, but then growth going forward. Post-COVID, productivity growth dropped away dramatically on the GDP figures we had at the time, resulting at the time in a decade average of zero. And it seemed like at that point, we're not just working with sort of just this line. We did a lot more digging, and decided that a slower rate of productivity growth going forward was probably a more realistic assumption. So you can see at least by half year 24, we're assuming a slower rate of productivity growth. The slope of the line is lower. As I say, the reasons for slower productivity growth, the retreat from globalization is I think one factor. Secondly, there's been, and in fact, New Zealand's exports and imports as a proportion of GDP have dropped away quite markedly from somewhere in the low 30s to the mid 20s as a percent of GDP. Investment has not been adequate to really build the capital stock as much as overseas. So New Zealand workers are working with not much more capital. And diffusion of new technologies has been, diffusion of new technologies through the economy has been inadequate. So Treasury lowered its productivity growth forecast. There's only a little update to the story, and that's with those GDP revisions. We already know how many hours were worked. Now Stats New Zealand is telling us that there was more GDP in the last couple of years than we'd previously understood. And it does actually improve, historically, the productivity picture. So the decade average is now 0.2%. And actually, this is not, mismeasurement was always a possibility for this large decline in productivity. So it's not entirely unexpected, but it makes me feel comfortable forecasting an acceleration to 0.9% productivity growth over this forecast from the 0.2 that we've had, whereas 0.0 to 0.9 was perhaps more of a stretch. Okay, so that's an update to the productivity picture. Obviously, we're working hard on this. So Ian Rennie, the Secretary of the Treasury, gave a great speech in February, outlined sort of broke it down, the work program, into 4 really key areas that we need to be looking at to bend this curve as much as possible. Forecasts are not destiny. International connections do appear to be that's something we need to build as much as possible. That means on the export front, free trade agreements. It means on the import front, allow competition into the country, and it means on the investment front, so allow and facilitate foreign direct investment into New Zealand. Capital stock and investment, so tax system, regulation to encourage investment, regulation and competition is a third area to look at to unleash productivity growth, connected to the capital and the international connections, and then facilitating new technology and the diffusion of new ideas through the economy. Other pieces of context that we just need to consider. First, the level of debt relative to GDP. It's above 40% now relative to GDP. That's not actually all that high internationally, but for example, if we went back to the 2006 long-term fiscal statement, at that time, the long-term projections were for debt to GDP to be well under 20%. So it's certainly higher than we anticipated 20 odd years ago, and it's getting closer to Treasury's assessment of the prudent level of debt in normal times, which is about 50% of GDP. There's a couple of reasons that we find ourselves with debt to GDP ratio that's quite a bit higher than we anticipated 20 years ago. One is that we're running a deficit, which I'll deal with soon, but the other is we've had large responses to downturns and crises that have not been matched by sufficient savings between the crises and events over this period, resulting in debt sort of ratcheting up over time. So Treasury recently published its long-term insights briefing, which dealt with this issue. So we've looked at how to keep fiscal policy sustainable through shocks and cycles. And basically, we're trying to take a sort of forward-looking approach, learn the lessons of the past, and talk about what we could do differently next time. The first thing that is use fiscal policy sparingly. So monetary policy should really be the main tool that leans against economic downturns. Fiscal policy can perhaps lean in to avoid real extremes in monetary policy. When you're getting down to zero OCR or to very, very high OCR, you might want fiscal policy to lean in. Fiscal policy might lean in order to rectify or deal with the direct effects of a disaster, rebuilding bridges after an earthquake, for example. And it might want to lean in to affect the distribution, how a disaster or economic downturn is paid for, where, when, and by whom. And that's something that monetary policy can't easily do. So those are the good justifications for using fiscal policy. And apart from that, let monetary policy do the job. Secondly, it's really important to make sure we look after or maintain the ability of the private sector to respond to shocks and cycles themselves. So first, maintain the flexibility features of the economy, flexible exchange rates, ability to switch industries and roll with the punches. Secondly, make sure you maintain incentives for the private sector to remain resilient by outlining exactly how or roughly how you might respond to disasters going forward, setting responses up ahead of time. And then lastly, the long-term insights briefing goes through what we've learned about the tools, the fiscal policy tools that can get used to help the economy out during a downturn or a disaster. International experiences that lump sum payments are timely, temporary, and targeted. They're a fairly effective way for fiscal policy to lean in. Whereas changing government consumption, so sort of changing the amount that the government spends, perhaps not so much. It tends to be really hard to reverse that, and it's hard to target it, and it's not particularly timely. So, for example, the large expansion of the school lunch program was a temporary measure funded under the COVID Response and Recovery Fund, which itself was there to boost the economy during a downturn. It gets hard. Experience shows that it gets quite hard to reverse those measures, meaning they're not easily temporary. Similar thing with fees, subsidies, benefits. Business loans can be quite effective and can be quite well targeted, but you run the risk So that can be a useful tool, but you do run the risk of keeping alive businesses that sort of preventing the natural churn that happens in the economy. The wage subsidy was largely successful. That was quite well targeted. We found that it could be done in a really timely fashion, and as long as it's got an endpoint, it can be timely. But capital investment, infrastructure projects, kind of helping the economy out, is one that too slow. So it tends to take time to get big capital investment underway, and it perhaps isn't. Experience has shown it's perhaps not the best way to lean in and help the economy through a downturn. Last or third piece of context is we've got an aging population, climate change, geopolitical realities that might change defence spending that are putting long-term pressure on fiscal policy. So in September, Treasury will be releasing the latest edition of its long-term fiscal statement, where we're going to take a retrospective look at how things have evolved relative to what we thought when we started doing this in 2006, what the outlook is now, and what some of the policy options are. And then later in the year, we'll be doing an investment statement, which will provide a little bit more detail on how to best steward the government's balance sheet, which is not just debt. We've got huge assets on one side and liabilities on the other. And stewarding that is an excellent way to look after the long-term challenges that we face. And the final piece of context is that we're running a structural deficit. And that means, so a deficit can occur because it could occur because the economy is weak and revenue is temporarily down. A structural deficit means that even if the economy was in normal times and not in a recession or in weak times, you would still be spending more than your expenditure would still be greater than revenue. And that is the case at present. Over the coming couple of years, the structural balance will be negative 1.9% of GDP. And what that means is that the government needs to take action to produce a surplus over time, which with its $2.4 billion budget allowances on our forecasts are sufficient to generate that over time. But again, adhering to that is going to require a series of decisions over time to adhere to that. Okay, so that's the fiscal context. Let's just talk about what the key initiatives in this budget. So first of all, investment boost. So this is a change to taxation for businesses who invest in new capital of various types, such as machinery. They can count the first 20% of an investment in new capital as an expense, and then start claiming depreciation on that investment from the first year. So it sort of brings forward the rate at which firms can claim tax deductions for expenditure on investment, and improves the net present value after tax of investments, and it will therefore lift the rate at which firms use capital in their production. So we're expecting firms to respond to this with greater investment. IRD and Treasury modelling, which does have uncertainties around it, but IRD and Treasury modelling settled on an expectation that over 20 years, the capital stock will be 1.6% bigger than it would have been without this policy. And that'll lead to 1.5% higher GDP and 1% higher wages than it would have been without this policy. So it's directly aimed at the dearth of capital that New Zealand workers have relative to compatriots overseas or peers overseas. And over the forecast period, in order to build yourself a bigger capital stock, we do expect firms to respond quite quickly. So we have lifted our forecast of business investment in response to this policy, and that has boosted our GDP forecast over 4 years by 0.4 percentage points. Secondly, government's changed. I'm sure you've all sort of already looked into this for your own personal financial reasons, but they've halved the subsidy for the government contribution for KiwiSaver. They've removed it for people earning over $180,000. They've actually extended it to people who are aged 16 or 17. That is going to, it leads to a fiscal saving of $2.2 billion, and it doesn't have much effect on the economic outlook for the coming 4 years. The contribution rates, default contribution rates will be lifted for employers and employees, will be lifted from 3% to 4%, but our assumption is that 80% of the employee contribution is redirected from other savings. So you might repay your mortgage a little bit more slowly and pay a bit more into your KiwiSaver. And 80%, our assumption is that 80% of the additional employer contribution is offset by lower than otherwise wage growth. So you pay your staff through KiwiSaver rather than in sort of the headline wage rate to the tune of about 80%. And therefore the effects on the economy and the economic forecast are pretty small, but it does have a quite large fiscal saving. Pay equity. So previously Treasury had an allowance for pay equity settlements. This is settlements in industries that are dominated by women. Claims can be made that these industries are underpaid, and a pay settlement might be reached where pay rates are increased. Government had previously set aside money to meet these expenses over and above, so it was going to be additional money paid to. It wasn't just that government departments and agencies were expected to manage with that pay increase. There was an allowance available there to meet this. Now the pay equity rules have changed, and it is likely that there will be fewer pay equity settlements reached, and therefore we would expect less public sector wage growth than our previous forecast. So our public sector wage growth forecast is a bit lower than it previously was. Not any change to the delivery of services is the same, but the lower wage rate itself is essentially a smaller transfer from government to the private sector, and therefore it affects private sector consumption, and it affects our economic forecast in that way. So lower wage growth, lower consumption, it sort of comes through in that channel. One difference, though, on the economic side is that that's temporary and it can be offset by monetary policy. So you'd expect interest rates lower than otherwise. And then the fiscal saving, $12.8 billion over time. It's had quite a large effect on the fiscals, as we will see. And then overall, the operating allowance, government had allowed itself initiatives worth $2.4 billion, but they actually only spent 1.3 of that. You've got to remember these allowances. I always like to put this picture out there. So previously they were planning new initiatives that are going to cost $2.4 billion per annum. This budget, next budget, and so on and so forth. A lower allowance this time will mean less spending every year going forward. We've got to remember that allowances are a sort of a net concept. So when you tot it all up across this budget, there is the partial expensing or investment boost, $5 billion of new spending in core government services, law and order, education, health, defence, foreign affairs and trade, those areas, paid for by savings initiatives, that's mostly KiwiSaver, other revenue initiatives, which is some IRD compliance stuff, and the savings on the pay equity side, and then the budget allowance of $1.3 billion. So that's the, so you can see, that budget allowance of 1.3 is smaller than previously. So the government, this budget's a bit tighter than we had forecast at the half-year update. But you've always got to remember that the economic side also affects the deficit and the like. So first of all, as we go back to the first part of the presentation, GDP forecast is a bit lower. Mainly, there's a few ups and unders and overs, but it's really the tariff side. So our forecast of nominal GDP is a bit weaker than it was, and that means a little bit less tax revenue going forward. But secondly, the amount of tax revenue we expect to collect relative to GDP is also lower. And you've always got to remember that that's one of the uncertainties that we deal with as well. Now, to be clear, the tax revenue to GDP ratio can change for all sorts of reasons. Policy is often the biggest one. There have been a couple of tax reductions in recent budgets, and that's reduced this thing GDP revisions are also something that changed this. So there's been a big GDP revision that reduced the tax to GDP ratio. But secondly, this, independent of the growth rate of the overall economy, the shape of the economy can affect how much revenue we get. So if you get sort of greater corporate profit and less wage growth, corporates are generally taxed slightly lower than wage earners, and so you're going to get less tax revenue. And that's actually been a feature this time. The shape of the economy was a little bit different, and that's pulled that the amount of tax revenue we expect to get relative to GDP. And then lastly, even the amount of tax revenue we receive relative to individual line items in the economy is a source of uncertainty. It wasn't a big one this time, but in previous years, for example, we were collecting a mysteriously high amount of GST relative to the number of sales that we have quite good visibility on going on out there. And that has dropped away to something more normal in recent times. So it didn't affect this budget, but it was one of the reasons that this tax to GDP ratio in our forecast was dropping away in recent years. On this occasion, policies played a role, the revisions have played a role, but especially the shape of the economy has played a role, and in reducing the tax revenue relative to GDP, particularly that's quite slower wage growth. So when we put all of this together, tax revenue going forward is likely to be less, is forecast to be less than forecast at the half-year update 2024. The total is $13.3 billion less, averaged over the 4 years. About half of that is due to policy, so the investment boost policy, and about half of that change in forecast is due to economic factors, the slower growth and the shape of the economy being different, so the line items being different. On the other side, on expenditure, it came in less than forecast for this year. That is mainly the pay equity settlements coming out of the expenditure. Going forward, fairly similar. Government's been restrained on its allowances going forward, but on the other side, the weak economy is expected to lift benefit expenditure. So putting those together, relatively similar core Crown expenses going forward and lower tax revenue means larger deficits relative to the half-year forecast. So on the Obergall X measure, which excludes ACC, we return to a very small surplus in 2029. Same date on Obergall X as forecast at the half-year update, but a slightly smaller surplus. And on the Obergall measure, still in deficit, no return to surplus within the forecast period, and the deficit just slightly larger than forecast at the half-year update. In terms of what that means for debt, there's a couple of things going on. Stats New Zealand has informed us that the economy is bigger than we'd previously realised through those revisions. So the debt to GDP ratio is actually a bit lower than we previously thought. But if you run slightly bigger deficits over time, then debt's going to be growing. It grows to about the same level as forecast at the half-year update, about 46% of GDP. And bottom line, these larger deficits, smaller surplus in the final year on the Obergall X measure, it's really down to a weaker economic outlook and therefore less tax revenue collected, partially but not fully offset by the government spending less, so smaller allowance, than it had previously allowed for. So I will, that's, I think, the summary. I'll stop there. Thanks very much. And we'll hand over for some questions either in the room or online. I'll introduce Peter Gardner, our Manager of Forecasting, who is going to intermediate the questions, perhaps answer some of them. I've got a few Treasury staff in the room who might help answer some questions as well.
Thanks, Dom, and thanks for your insightful presentation once again. There are a few questions online, but before we go online, I just thought I'd open the floor to see if there are any questions in the room.
Again, I think the ratio of online to in person is probably dictates that we go online for a bit. But
all right, so why don't we start? Well, start with a few online questions, and hopefully that will warm the audience up a wee bit. So the first question is more around, how do we think about turning the corner? Is this more of a monetary policy sort of cyclical thing, or and not really a structural or fiscal policy thing? What do you think, Dom?
Well, I think structurally the default position for an economy is growth. As the population grows, as technology improves, productivity growth is above zero, you tend to grow over time. That is the norm for an economy. Now, structurally, in recent years, we have identified that productivity growth was a little bit slower than it was in recent decades. The budget itself caused us to slightly lift our assessment of the structural growth rate going forward, and that's because there'll be more investment than there would have been without the investment boost policy. But really, the big picture, so why is the economy turning around? Well, it's more the absence of monetary restraint. Monetary policy was really restraining things temporarily, leading to a temporarily negative change in economic activity. As that monetary restraint disappears, I would expect to see the economy return to its default position, which is growth.
Another question online, just touching on some of the explanation we gave around the composition of our migrants and people leaving the country. And the question is, how worried should we be about the compositions that we're seeing, the people leaving New Zealand and the people coming into New Zealand, and what's the implications of that for long-term productivity?
I think perhaps, how worried should we be? That's a normative question. People can be as worried as I'm not going to tell people how worried to be. I feel a little less worried than some of the concerns out there. New Zealand has long experienced an exchange of people. People have left, people have arrived. We have a very large foreign-born population, and we have a very large diaspora overseas. The net number of people, but during the 1970s, there was actually a net outflow. But in the 2020s, there is a really clear net inflow on average, and that is going on. Our look into exactly who is leaving, as I said, they're a little bit older than in previous periods of exodus. They're going a little further. There have been various assertions made about their skill level. I don't know where people have got their data on that. We were unable to identify good data on the skill level of the people leaving, so I won't opine. And in terms of the people coming in, I think that the key is just to make sure that we're getting the skills that match our needs as best we can. The other thing about having this quite high rate of net growth, there's a couple of things. First of all, I was stunned when we looked back over long-term fiscal statements and found that in 2006, the population was forecast to peak at just over 5 million. And in 2021, it was forecast to peak at 7.5 million. I don't know what the forecast is now, but it's likely higher again. So we're building infrastructure for a much bigger population than we expected a mere 19 years ago. So uncertainty about the size of the population is a really an important factor for the capital side of the government and the private sector, actually. And secondly, the more rapidly your population grows, the easier it is to service a given level of debt. So this larger than expected population is finding it easier to service debt that previous generations built up than they might have expected. So there's kind of a double-edged sword. It's probably, I've been to Japan and Finland and countries where their populations aren't growing, and they're awfully worried about aging. So migration sort of is one of the ways that we deal with the aging issue.
Thanks, Tom. The next question is probably one that's going to be directed to me.
Oh, you can take it. Read it out and take it.
Yeah. So there was, and I think it was sort of prompted by your sort of retrospective on the revisions to GDP, and the question is really around how much of worry should we have in the quality of economic statistics. So hence I'll take that one. I think the most important thing to note here is that, through COVID and post-COVID, we saw a rapid change in the structure of the New Zealand economy. And it was a phenomenon that we saw all over the world, that statistical agencies really had trouble keeping up with that. What statistical agencies do really well is they do annual benchmarks, and they've worked really hard. I know Stats New Zealand have worked really hard to improve the quality of their annual benchmarks, which then flow into their quarterly statistics. And so they're still trying to work on improving those quarterly statistics. But I've got faith and confidence that our statistical agency and agencies all over the world are working as hard as they can to ensure that the quality of our economic statistics actually reflects what's happening in the economy. So I don't have any fears. I know that they're working extremely hard to do that. Now, the next question I think might go to one of the experts in the room. And it relates to investment boost and some of the thinking around that. And in particular, should we have considered full expensing of plant machinery and things like that? So I think that, want to answer that? Yeah.
Feel free to introduce yourself.
Don't knock that over. G'day everyone, Dan. I'm from the tax strategy team here at the Treasury. So to the question of partial expensing versus full expensing, we did explore that issue during the development of the policy. One of the things that became reasonably apparent to us is that there is a point at which offering progressively more partial expensing up to that full expensing point starts to create subsidization for certain asset classes. Basically, as you approach closer and closer to that 100% mark, the level of subsidization grows. And we found that the sweet spot was around about 40%, after which point the subsidization risk grows quite large, and therefore the overall economic efficiency of the policy begins to decline quite rapidly. So to the extent that we would recommend the policy, our recommendation sort of stops at that 40% point, because functionally the dollar value for each additional dollar of foregone revenue from going beyond that point is overall less efficient.
Cool, thank you. I've got one more question online, which I think is really just a clarification. So the question is whether or not we modelled the impact on GDP of the $1.3 billion reduction in operating surpluses in the 2025 budget. And the simple answer is yes. So our economic forecasts include the decision to reduce the budget allowances in 2025 by that amount.
Yeah.
So look, that's all the questions I have online for the moment. So again, a
couple of in-person questions.
We've got a couple of questions in the room, which is good. So why don't we handle that?
Hi, Dominic. Just wondering if you could provide more information on what you expect to actually boost, or what there's going to be behind the forecast and productivity growth. You talk about the standard way that our economy is to grow anyway. Is that mostly a reflection of the capital investment boost, or is there something else that's actually going to contribute to our productivity actually improving? So
yeah, first of all, so how do we come up with the 0.9% on average growth in productivity in our forecast? It is the 30-year average. So we have it is actually really hard to forecast productivity growth going forward, because productivity emerges from new technologies, finding new ways to do things, getting people to work harder or not. There's a really wide range of factors behind productivity growth that are extremely hard to forecast. So in terms of its long sort of far further ahead forecast. Treasury relies on the 30-year average. In the nearer term, there is a negative correlation between productivity growth and migration. So when you have a huge influx of people, you're essentially throwing a whole load more people at a fairly fixed capital stock. And it takes a while for the economy to absorb those people, so productivity growth tends to drop away. So you see, so productivity growth, we would anticipate lifting as migration has recently normalised, and as it sort of stays normal, we'd expect to see that burst of, or stronger productivity growth. There is also there tends to be slower productivity. I mean, when the economy is in a productivity is GDP divided by hours worked. So when GDP is really weak, you tend to see slower than normal productivity growth. So we don't think that the declines that we've seen recently represent a reasonable sort of trend. Going forward, you would expect it to be stronger. And there's actually also a phenomenon when you come out of recessions, you tend to see stronger productivity growth because you've had churn in the economy. You've sort of thrown the cards up and reorganised them in a better way. You've got more creative destruction, if you like, that you tend to see after recessions. So there tends to be slightly stronger productivity growth and weaker during recessions. So I think all of those reasons, I think we've got really good reasons to forecast productivity growth to go from something stronger than the negatives that we've seen in recent years. I mean, that is just not a good long-run forecast. We've got really good reasons to expect it to accelerate. Where it accelerates to is, again, it comes down to sort of big picture questions like, to what extent is AI going to lift the efficiency with which we work, and to what extent is it going to prove a distraction? And I think that sort of thing is really quite speculative, and the best thing a responsible forecaster for the government's books to give advice on what revenue is going to be over time is the 30-year average. Perhaps conditioned by research and conditioned by observations such as, well, globalization appears to be slowing, and so perhaps that's the reason it'll be slower than it was previously.
There was one more question here, and then I've got one more question on.
Oh, thank you. My question, a bit like the previous speaker, is about the story of productivity and what we can do to enhance it. You mentioned a number of factors already. Could you maybe talk a bit more about technology adoption as one of those factors? And if during COVID, our working remotely helped with some of that. And also, I think there was a productivity commission that existed in New Zealand, which was abolished. Is the thinking being carried out somewhere else on that front? Thank you.
So on the thinking, yes, Treasury is thinking hard about productivity. So we've got people who've worked on it here in the room. We've got so improving productivity growth is a really key platform of our economic strategy work stream. So in terms of technology adoption, first of all, on working from home, I think that there's a range of evidence. My understanding is that industries that have adopted more teleworking have experienced a productivity lift. Actually, Diana's our expert in the room at the moment. Is that's where the literature is at? Or
yeah,
did you want to cover?
I'm not really an expert on teleworking, but I think the evidence has been changing a bit, that initially they thought it had a positive boost, but it's less clear over the longer term whether that's the case. Yeah.
So fairly contested evidence on the working from home. In terms of the adoption of new technology, that's an interesting one. In New Zealand, firms get away with not operating at the frontier in a way that they do not in countries like the United States. So there are firms, we have firms at the frontier, but we have laggards to a greater extent that remain in the market and remain solvent more than they do in the United States, and are using sort of not adopting new methods as frequently. And then you sort of think, well, how is that? Why do we end up with a situation like that? And well, there's fewer competitive pressures driving them out, driving the less of, forcing them up the curve. Why are there fewer competitive pressures? Well, like a lot of things, the productivity puzzle comes back to we're small and isolated, and it's just harder to create scale and competition in a lot of industries. But in terms of what we can do, so small and isolated is something that we can't change, but ensuring that our regulatory systems are fit for purpose and don't create barriers to entry, for example, so that allow churn, ensuring the flexibility features of the economy that I've mentioned a couple of times remain in place, allowing new methods to emerge, and ensuring competition, both through competition policy can have an effect on the competitiveness in industries, but also openness to the rest of the world. Because if you sort of prevent foreign competitors coming in, actually what you're doing is preventing new competitors from entering a domestic industry and sort of preventing those firms or not forcing those firms up the value chain. Diffusing technologies, one thing that the literature has found is that hubs of excellence essentially are places where productivity can be grown. So bigger cities are more productive. So it's really important to look after your big cities, to allow the exchange of ideas, to allow firms to co-locate, firms of a like type to co-locate with one another, so that workers can perhaps move more easily between those firms, thus sharing ideas and diffusing new technologies. So you don't just have one firm that grabs the new technology and operates at the frontier. You lift all boats. Those are just some of the key things that the literature says are important for productivity growth. And then if you think about the policy implications, you've got urban policy in there for looking after your cities, you've got competition policy, you've got regulation, you've got foreign policy or trade policy. There's many elements of policy, and it's really important that all of those elements, as we're considering and developing that policy, that we think really hard about the effects on productivity, as well as the effects on, of course, on a wide range of things through society. I think that's a good finish. It's sort of a more positive finish on what we can do to lift why productivity is forecast to grow according to the Treasury, and what we can do to bend the curve as much as possible. So with that, I think we'll close unless there were any other. No, I think we'll close here. So piki te kaha, piki te ora, piki te wairua, hui e tai kia. Thanks very much.
Thanks, Dom.
Oh, and thanks especially to those in the room, because it's much easier to talk to